Well, good afternoon. Time to check in on the markets as we wrap up the week. Noticing that Asian markets are climbing a little bit higher. And just to point out that mainland China and Hong Kong markets are closed for a holiday. Nonetheless, investors are looking ahead to the Friday jobs report numbers that should come out at 2:15 SA time. This will give clues in terms of the Fed's policy rate, in terms of the pace of rates that we can expect to see for the year. So definitely the markets are keeping an eye on that. We did see the rand flat just now, 15.49. When we look at the Asian markets, wrapping it up in Japan, the Nikkei up 1.25%. We also have news that investors that are digesting what happened out of OPEC Plus and the discussions around the oil-producing allies agreeing to ramp up output for July and August as we see the Russia tensions roiling the global energy markets. The agreement between the allies is to ramp up production by 50% for both July and August. But to talk to us about the week that was, and perhaps even throw into next week, we are joined by Warwick Lucas, who is the head of Galileo Securities. Warwick, thank you so much for your time. I mean, let's check in on the JSE. How are we holding up right now? And I suppose let's look back at the week that was. Were there any company news that caught your attention?
Well, I guess we could certainly talk about the week that was. I mean, it was pretty much, although as many of the weeks have been quite choppy, I would say it was a relatively subdued week on the JSE. I mean, we certainly saw quite a big recovery on Wall Street this week, but in the case of South Africa, the strength in the rand dollar, I think, took a bit of a shine off. Our market tends to move the other direction compared to the dollar rand price, and since that was so muted, so our market wasn't that strong. But the CRB is strong. Now the CRB is the commodities complex. Those are very, very strong, and it explains, I think, that strong rand. And certainly that, I think, is quite a nice longer-term underpin for both our economy and our markets.
Let's talk on the OPEC Plus meeting, and I'm wondering what the market's reaction is to that. Is it finding it encouraging that we're ramping up by 50%, or is it, I suppose, an underwhelming meeting?
Well, the key issue here is that whatever gets taken off from Russia has to be found from somewhere else. And the market concern was that there wasn't enough from somewhere else. So the net result is, well, okay, we're going to have to pay more. So that's I think, quite a short answer, though, to quite a long sort of problem. I mean, it's a market always with a lot of dynamics. I mean, on the one hand, we can see U.S. rig counts are steadily rising. I mean, that you would think is good long-term news for the oil markets. I mean, there's other areas where production can be picked up. I mean, markets such as, or producers, I should say, such as Venezuela, Angola, and Nigeria all have their plant that's worn out. It needs to be improved and what have you. But of course, years of weak oil prices saw those decline, so it's going to take a long time to pick them up. At the same time, China's recovering, and of course, China, when it gets going, is going to take a massive amount of oil off. So there's a lot of moving parts to this oil market, and I think the market is concerned that there wasn't enough certainty brought back in by the production increase announcement.
After 8 weeks of, call it a brutal sell-off, is there some kind of optimism lingering in the market somewhere?
So what we've been seeing, and I think it's really been the tale of 2022, is the question of a balancing act. And that really is that, well, in 2021 and even earlier, we had an enormous amount of reflation, of stimulus coming out of central banks to tide consumers through the whole COVID crisis and the unemployment that stemmed from that. And it's a case of, well, that bill has to get paid, and that payment would be in the form of inflation, which, if not dealt with, would cause spiraling economic problems, and the way of dealing with inflation is rate hikes. So that's clearly a case that we have to see that inflation problem is headed off, but without smashing the economy. And it's quite noticeable. I mean, looking at the kind of ADP data, that's the employment data from the US, when you look at the segmentations, I mean, that data was quite weak when it came out. And looking across, I mean, particularly industries such as leisure and hotel and other cyclical type employment, those were really sharply much slower growth than we've been used to in the past. And that's telling me interest rate hikes, which are only just starting to really get going, have already bitten quite deeply in the US. And I think the thing that the US needs to be careful of is that they don't overdo it, that there's a bit of moderation as that hiking cycle climbs.
On that note, then, what's the market expectation for the US jobs report?
Well, I think we're only going to see a bit later just what that number looks like. Look, the ADP number, which was 128,000 up, was half of what a typical number looks like. So what the farms non-farm payrolls is going to look like, that's I think given that kind of messiness we saw in ADP, I mean suddenly any kind of forecast looks kind of messy. And of course, as we know, there's often revisions in that data. So I think we need to be careful of knee-jerking to whatever number comes out, because there's clearly a lot of scope for error.
As we wrap up, going into next week, any key events you're keeping an eye on?
At this stage, I'm pretty much standing pat. I am also not sort of being in any way aggressive. I think the market, although it's become a lot cheaper courtesy of the falls that we've seen, I mean, there's quite a lot of economic noise to work its way through. So I'm not panicking, but I'm also not rushing in aggressively either.
On that note, let's leave it there, Warwick. And of course, next week we are looking out for the ECB's interest rate decision, as well as the May US CPI figures. That is it for me. We're going to take a quick break. When we come back, we'll have more for you, so stay tuned.